Hey veterans, my name is Steve Doherty. I'm the Raleigh VA loan guy. Today I want to talk to you about whether it always makes sense to use your VA entitlement when buying a primary residence. In other words, is there a better option out there when you are buying a home that you intend to occupy? Today I want to talk to you about 3 scenarios under which it might actually make more sense to get a conventional mortgage. By the end of this video, you will understand all 3 of those scenarios and you will be better armed when it comes time to make your next purchase. But before we look into that, again, my name is Steve Doherty. I'm a loan officer in Raleigh, North Carolina, and a United States Marine Corps veteran. I work for Advantage Lending, and I am licensed to do mortgages in South Carolina, North Carolina, and Virginia. If you would like me to get you pre-approved for your next mortgage, I will leave my contact information in the video description and in a pinned comment below. I really look forward to hearing from you. Okay, so first, it is pretty hard to beat a VA loan. It's 100% financing. There is no monthly mortgage insurance. It has a permissiveness when it comes to credit, low credit, and a permissiveness in terms of a debt to income ratio. It lets you get a much higher debt to income ratio than any other loan program, especially if you have really good credit. And overall, the interest rates are just better on average on a VA loan than they are on a conventional mortgage, the typical alternative to a VA mortgage product. So why would you ever want to, venture far away from a VA loan? It sounds like kind of a perfect deal. Well, there are 3 circumstances. Let's take a look at the first one. Okay, it depends on if you have a disability rating or not. If you do have a disability rating, it is going to be very difficult to justify not using your VA entitlement, meaning it will be hard to have a conventional loan outperform that VA loan. The interest rate will likely not be better, right? It will have no monthly mortgage insurance regardless of the down payment. The interest rate will probably be better as well. If you don't have a disability rating from the VA, that means you will have to pay a funding fee. Please check out my video on the funding fee, explaining everything you need to know about that. But a funding fee is a percentage of the loan amount that is either added back to the loan amount or is paid for in cash at the closing table. 99% of the time, it is simply added to the loan amount. Now, the funding fee will vary depending on your down payment, but it is increasing the loan amount. It will increase the loan amount more depending on whether you're putting 5% down, 10% down, or doing 100% financing. It will also vary on that 100% financing option, depending on whether it's your first time using your VA entitlement or a subsequent time. And we're going to sort of feather this into the second consideration, which is whether you plan on making a down payment. Maybe you are intent on lowering your initial loan balance and you want to make a down payment. Maybe you've saved for it and that's where you want your money to go, into that down payment. Or maybe you've just come off the sale of other real estate and you sort of have to keep it in a primary residence to avoid some kind of taxes. Either way, if you are making, let's say, a 20% down payment on a conventional mortgage, you will not pay any mortgage insurance upfront or monthly, right? There's no mortgage insurance if you're putting down 20%. On a VA loan, no matter what your down payment is, you will be charged a funding fee if you do not have a disability rating from the VA. So on any VA loan where you're putting down 10% or more, the funding fee in 2025 will be 1.25%. So if you're purchasing an $800,000 home and putting down 20%, that means you have a loan balance of $640,000. 1.25% of that, which would be the VA required funding fee, even though you're putting down 20%, would be $8,000. Now you have a starting loan balance of $8,000 higher on the VA loan than you would if you just did a conventional mortgage. Why am I choosing 20% to make that the illustration point? Because if you put down less than 20% on a conventional mortgage, you will pick up mortgage insurance. You could elect to pay that on a monthly basis, or you could do a single premium insurance, which would kind of look similar to the VA funding fee, but it would be paid at the closing table. So let's take a look at the numbers to see if in our scenario, it would be better to use a conventional mortgage versus a VA mortgage. Again, in this scenario, we're contemplating that this VA buyer does not have a disability rating from the VA, but he's putting down 20% on 3 different scenarios. Each involve the purchase price of an $800,000 home, and each has a starting loan balance of $640,000, with the VA loan having a starting loan balance of $648,000 because he is financing the 1.25% funding fee. So you'll notice that the VA has the lower interest rate, right, at 5.5%. That's probably going to be accurate in most scenarios. The VA loan is going to have the better pricing. And we're going to compare it to 2 other mortgages. First is if the conventional alternative at 20% down would give him a 5.875% interest rate. And then also if that 20% down could give him a 5.625% interest rate. Now, again, this isn't necessarily exactly where the rates would fall. What we're doing here is we're seeing at what point does the conventional mortgage become a better option because you do not have a funding fee, right? That starting loan balance is $8,000 less. So let's take a look at the interest projections. So over here on the right-hand side of the page where it says monthly payment difference, these 2 bars represent how much less these mortgages are than the highest monthly payment. So the highest monthly payment would be 20% down on a conventional mortgage at 5.875%. So the reason this is higher is because the interest rate is 3/8 higher, 5.875%, on a loan amount that is only $8,000 less. So at 5.5%, the VA mortgage is going to be the better option. You have the better monthly payment. Again, going down to savings over 12 months, the VA loan is the better option. If your interest rate at that purchase price is 3/8 lower, it is going to be a better option for you, despite the fact that the loan amount would have a starting balance that is $8,000 higher, again, because you're financing that funding fee, right? Over the course of the first 12 months of this mortgage, the borrower would spend almost $2,000 less on the VA loan despite the funding fee because the interest rate is 3/8 lower. If you go down and look over the course of 3 years, the VA loan would be $5,913 less in interest payments over the course of those 36 payments. So what this is just showing is the total interest spent on the conventional mortgage at 5.875 versus the total interest spent at 5.5 on the VA loan. And the reason it's less is because the interest rate is quite a bit lower. In this case, it doesn't really matter that the funding fee is being added to the loan amount because the interest rate is so much better. Now let's go back and look at the difference between the VA loan at 5.5% with the funding fee versus at 5.625 on the conventional loan. Obviously, if the interest rate is 5.5 on the conventional loan, the conventional is going to be better because it has a lower starting loan balance. In this scenario where the interest rate is only 1/8 higher, you'll notice that the 2 monthly payments are almost the same. The VA loan is only cheaper by $4.93 on a monthly basis. Similarly, over the course of 12 months, this borrower would only save $363 in interest payments by virtue of having the 5.5% interest rate versus the 5.625. So they're very, very close in terms of interest costs. And down here, the borrower is only saving $1,107 by having the VA loan. So the VA loan, from a cost perspective and a monthly payment perspective, the VA loan is still outperforming the 5.625, even when the interest rate is only 1/8 better. But if we compare how much equity there is in the home, the conventional mortgage is outperforming the VA mortgage. So in this calculation where it's saying net worth in 3 years, the only net worth it is measuring is equity in the home. So in this case, the borrower has $286,000 of equity because they did not have to make that $8,000 funding fee payment. They didn't have to add that to the loan amount. Compared to the VA loan, the net worth, or really the equity, is $279,584. So this is reflective of two things. The homeowner owns a larger percentage of the home on the conventional mortgage, and the loan balance is higher on the VA loan. So especially in the short term, while the interest payments may be slightly better, right, over the course of 3 years, it's about $1,100 that you're saving by going VA with the 1/8 lower interest rate. The balance of the mortgage is higher on the VA loan. So if you were to sell that mortgage or sell that home, you would make less money because you have to pay off a larger loan amount by virtue of having that funding fee. One more thing to look at here, we're comparing the interest spent over 30 years, right, 360 months on these two closer performing mortgages. So the VA loan would save you about $11,000 over the course of the life of the loan versus the conventional mortgage by having that 1/8 of an interest rate. A couple of things to keep in mind. Number one, this is imagining that you're keeping the loan for 30 years. The odds of that happening are pretty low, right? Number one, if it's a first-time home that you're buying, on average, that you will not stay in that home. You'll sell it within 5 to 7 years. The other thing is the odds of you not refinancing this mortgage are pretty low as well. So, and then the other thing is this is a large loan amount. Those savings would be less pronounced on a smaller loan. So I think the takeaway here is if you plan on selling that home in the short term, or if it's a home that you don't plan on staying in forever, in this scenario, if you can get an interest rate that's within 1/8 of the VA loan, it's probably better to go conventional. If you're going to be keeping this home forever, especially if you don't think you'd be refinancing, then the VA loan would be the better option, even with that $8,000 funding fee. So for starters, if you plan on holding this home for a shorter period of time, and you're not going to fully pay off the mortgage, down the line, you will be selling a home with a lien that has a higher balance on it. What does that mean? That means you will make less money when you go to sell the home. You want to compare a couple of things. Number one, what is the interest rate on the VA loan versus the interest rate on the conventional mortgage? 9 times out of 10, a VA loan is going to have a better interest rate. However, at certain large down payment percentages, that gap starts to close, meaning that if you're making a 20, 25%, 50% down payment on a conventional mortgage, those interest rates might get better on the conventional side. For some lenders, they may actually offer a better interest rate on the conventional mortgage when you're making a very, very large down payment. Let's say the VA mortgage does have a better interest rate, but only by 1/8. To achieve a 1/8 better interest rate, you will be sort of unnecessarily increasing your loan balance, your starting loan balance, if you go VA, don't have a disability rating, and then you have to add that funding fee to the loan amount. Okay, so factors 1 and 2 sort of blended into one, but here is a separate consideration. If you are purchasing a primary residence, but you do not intend to stay there for a long period of time, in other words, this is not your dream home, it's a starter home, maybe you are only going to be there for 2 to 5 years. And you know after that, you are going to move into a bigger home, right? Maybe you're retiring from the military, and in your first year out, you do not have gainful employment lined up yet. You'll have your disability pay from the VA, assuming you get a rating, and you'll have some retirement pay. So you feel comfortable purchasing a home, but you don't really know what your cash flow is going to look like once you find a job. Maybe you'll be making $100,000, maybe you'll be making $250,000. Either way, you are buying a home that's very affordable now, but it will not be your forever home. Eventually, you are fairly certain that you will upgrade homes to a bigger price tag. So while the VA loan does not have a maximum loan amount, investors impose maximum loan amounts. The VA does cap you in terms of how big mortgage number 2 can be on a VA loan if you have outstanding VA loan mortgage debt. it's not really a calculation of how much debt you have. We actually look at a thing called your charged entitlement, which is sort of tied to the initial loan balance you had on existing VA mortgage number one. If you have charged entitlement because you have an outstanding VA loan, eventually there will be a maximum loan amount that will kick in on house number two. But there won't be a maximum if house number one is purchased with a conventional mortgage. So if you know down the road in 5 years, house number two is going to be a much, much bigger purchase, it may make sense to leave your VA entitlement untouched. That way you can go, you'll be able to do 100% financing on house number two. If you have a VA loan on house number one and you want to go buy house number two, and let's say you have $80,000 of charged entitlement and you want to buy a $700,000 home for house number two, you will run into a maximum loan amount and you could potentially have to make a large down payment, which sort of defeats the purpose of having a VA loan. So a way around that would be to use a conventional mortgage or even an FHA mortgage on house number one. And when you go to buy house number two down the road, upgrading, you know for a fact you'll have access to 100% financing. Otherwise, you may have to make a contingent offer on your home, on home number two, because you need your VA entitlement to be restored by virtue of selling that home before you can turn around and go 100% financing on house number two. Again, my name is Steve Doherty. I'm the Raleigh VA loan guy. I'm a loan officer in Raleigh, North Carolina, and a United States Marine Corps veteran. If you would like me to help you with any mortgage-related questions, please reach out. I look forward to hearing from you. Thank you so much for watching this video. Please subscribe, and I look forward to seeing you again.